This presentation is merely a brief overview of the topics covered in the chapter and should not be considered a substitute for reading the chapter. This chapter covers the reasons why mutual funds make good investments, the secrets of successful fund investing, how to allocate your assets, and how to find the best mutual funds. There are many reasons to invest in mutual funds. The first that usually comes to mind is that mutual funds provide instant diversification. Small investors often find it difficult to buy stocks of many different companies in many different industries because they have only a small amount of money to invest. Buying as little as a single share of a mutual fund can provide instant diversification because the fund may own shares of stock in hundreds or even thousands of different companies. Professionally managed mutual funds employ a professional portfolio manager who has expertise and experience in investing and a team of researchers who help the portfolio manager find good investments. This team of professionals does all of the research, number crunching, and due diligence for you, freeing you up to focus on other things in your personal and professional life. If you were to buy stock in 500 different companies, you would have to pay a commission for each of the 500 trades necessary to do so. If that commission were $10 per trade, you would have racked up $5,000 just in commissions. Mutual funds pool all of the investors' money together and then trade, spreading the commission costs among all investors, not just a single investor. If a mutual fund has 50,000 investors and makes 500 trades, the cost to each investor is only $100, which is certainly much better than the $5,000 it would cost a single investor to make the same transactions. When you're just getting started in investing, it may be difficult to find a lot of surplus capital to invest. Mutual funds usually have low minimum investment requirements. An investor who has $1,000 or $2,000 to invest can invest that money in a mutual fund and then follow it up with monthly investments of $50 or $100 per month, building their nest egg slowly over time. Are you uncomfortable with the risk of stocks? No worries. That doesn't rule out mutual funds because stock mutual funds are just one type of mutual fund. There are also bond mutual funds, which typically are lower risk, lower reward types of investments, and money market funds, which are very low risk, low reward investments. Most investors who have a sizable portfolio find themselves investing some of their money in stock, bond, and money market mutual funds. Whatever your risk tolerance and time horizon for investing, there's a mutual fund that is right for you. With some investments, you can lose all of your money if the company you invested in or with fails. With mutual fund investing, that won't happen. For every dollar of securities that a mutual fund holds for their customers, they must have a dollar's worth of securities. The worst that can happen is that when you decide to sell your investment and take back your money, you may end up with less cash than you originally invested in the fund. One last benefit of mutual funds is accessibility. It's difficult to beat the accessibility and liquidity of mutual fund investments. Most mutual funds allow investors to fund their accounts and buy and sell shares online. In addition, most money market mutual funds allow investors to write checks from the accounts. Once you've decided to invest in mutual funds, there are several things you should do to maximize your chance of success. The first thing you should do when considering which mutual funds in which to invest is to focus on funds that have low operating expenses and do not charge loads. Loads are commissions. Brokers love load mutual funds because they make money when you buy them. Even though your broker may try to steer you toward a load mutual fund, you should keep in mind that there are many objective studies that show that load mutual funds do not outperform no-load mutual funds. In fact, no-load funds outperform load funds. Save the 5% commission that would go in your broker's pocket and buy only no-load funds. Past performance of the mutual fund is important when considering which fund to buy, but past performance does not guarantee future results. As our author points out, some mutual funds have performed well in the past only because they took on big risks. We know that high-risk investments need to deliver high rewards, while lower-risk investments can deliver lower rewards. Be sure to consider the amount of risk that you're comfortable with and find a fund that is a good fit for you. If you prefer lower-risk investments, you may have to settle for a fund that isn't at the top of the past performance charts, but you'll probably sleep better at night knowing that your investment should not fluctuate in value as much as some of the high-performing funds do. Most investors prefer to invest in funds that have experienced professional portfolio managers who have good track records. It's also a good idea to pick a fund company that has experience as well. T. Rowe Price, Vanguard, and Fidelity all have decades of experience and are respected mutual fund companies. Index funds are an excellent choice for many reasons, but one that stands out is their low fees. Many mutual funds have expense ratios of 1% to 2%, with some even higher, but it's fairly easy to find index funds with expense ratios of 0.2% and lower. Such a low expense ratio puts an investor at a big advantage right out of the gate. Consider an index fund with a 0.2 expense ratio and compare it to a professionally managed fund with a 2% expense ratio. Each year, the professionally managed fund starts out in a 1.8% hole because of the higher expenses. So just to meet the real return of the index fund, it must return 1.8% more. That may not sound like a lot, but it certainly is. Over time, 1.8% really adds up. ETFs are exchange-traded funds. They pool investors' money together and invest it like a mutual fund, but they are bought and sold on standard securities exchanges and can be bought and sold at any time during the trading day. ETFs allow investors who prefer to time the market to do so right down to the minute, while mutual funds can only be traded at one time per day after the market has closed. ETFs also allow small investors unique investment opportunities. For example, by buying and selling an ETF, a small investor can invest in commodities like gold, oil, and corn. Normally, these investments are limited to those who trade on special exchanges or who want to take possession of the commodities. I encourage you to learn more about ETFs by going to Yahoo Finance and reading their excellent ETF educational materials. There are suggested methods for determining how to allocate your assets among investments. Our author suggests a safe, medium, and aggressive strategy, which is shown here in the top table. If we use that table to determine the appropriate mix for someone who is 25, we'll find that they'll be heavily weighted towards stocks, even if they prefer the safest strategy. Why? Because stocks have provided the best investment returns over time, and someone who is 25 has decades to overcome any serious downturn in the stock market. We can see here in the bottom table that as one ages and nears retirement, they should take less risk. Someone who was 25% bond funds and 75% stock funds at 25 should be 50% bond funds and 50% stock funds at age 50. Even the most aggressive investor should pare back stock holdings as he or she gets closer to retirement. Once you have determined your asset allocation between bond funds and stock funds, you may wish to consider how much you want to invest in the U.S. markets versus how much you want to invest globally. The author offers a specific recommendation, but I would encourage you to do a little research on your own and find a mix that you're comfortable with. The author does a nice job of explaining how to find the best mutual funds for you, be they stock, bond, or money market funds. I can't really add much to that other than to point out that one of the most popular stock mutual funds is an S&P 500 index fund. While many companies offer such funds, Fidelity and Vanguard are two of the most respected, and they both offer extremely low fees. Here we see the Vanguard 500 No-Load Index Fund. For investors who have less than $100,000 to invest in the fund, the expense ratio is a very low 0.18%. For those who have over $100,000 to invest in the fund, it drops to an amazingly low 0.07%. I speak with many investors, and nearly every one of them has a substantial amount of their retirement savings in a fund like this one. It offers instant diversification, good historical returns, stock in 500 good US-based companies, and an extremely low expense ratio. You may want to consider it for your own portfolio. That is the end of this presentation. I hope you enjoy reading the chapter.